Bets on the space-based economy, artificial intelligence, and longevity tech firms are some of the best long-term opportunities, according to investment managers. Many investment strategies focus on long-term growth, but oftentimes it's difficult to imagine just how different the future might look decades from now. Humans could have longer lifespans, benefit from the burgeoning space-based economy, rely on artificial intelligence, and operate with a whole new set of geopolitical risks. At least these were four of the big-picture trends investment managers zeroed in on the biggest opportunities for investors in the future. Below, they share their analysis on these trends, which could change how we live, work, and invest, and how to have a smart approach when investing. Before contemplating any future investment, however, it can be important to focus on the present and be sure your finances are well protected from any shorter-term setbacks. A look at the 7 habits of highly effective investors can help you start that process. The space-based economy. The vision. Most people have preconceived notions of the space economy as the Apollo moon landing and the International Space Station of grand human achievements. They don't typically think about entrepreneurs transforming nearly every major industry here on Earth, but that's the multi-trillion opportunity our venture fund focuses on. The space economy is much more than rockets and satellite hardware. Space technologies are playing an increasingly vital role in our economy and will continue to transform the world's largest industries. In times of uncertainty, enterprises and governments want more information, not less. Space technologies are critical infrastructure, and enterprises and governments continue to spend across market cycles. The opportunities. The key tech stacks are GPS, geospatial intelligence, intelligence gained via analysis of imagery and signals on Earth, and satellite communications. Emerging industries get a lot of media, lunar markets, space stations, but are a small part of what's going on. The history of GPS provides a framework for understanding how space-based technologies can create new investment opportunities. GPS was built by the government, for the government, and was off-limits to anyone else by design. But companies like Trimble and others developed commercial receivers to harness this valuable positioning signal. They made it accessible to the tech community, which built location-based services such as Google Maps, Uber, Lyft, Foursquare, and even Pokémon Go. We see the same thing playing out in geospatial intelligence. Low-cost access to orbit via SpaceX enabled the launch of distributed networks of hundreds of small satellites, which generate an unprecedented amount of new data. We're starting to see the first distribution companies in GeoInt, such as Skywatch, as well as new applications being built on top of this dataset, like Arbol, Regrow, Indigo Ag, and Shield AI, that focus on multi-trillion-dollar industries such as agriculture, insurance, construction, and more. SpaceX will bring us into the next phase of the space economy with its Starship vehicle, which will be the world's largest, most powerful, and first fully reusable transportation system designed to carry both crew and cargo to Earth orbit, the Moon, Mars, and beyond. It will lower the cost of getting into orbit by another order of magnitude. It will open the door to many new possibilities, from hotel-like tourism in orbit to lunar-based stations, off-Earth manufacturing plants, and more. Most of the action is in the private markets, but we're beginning to see some companies list on public markets. There's been speculation about the potential for SpaceX to spin off Starlink, but this is just one of many emerging opportunities for retail investors. Just as the tech industry went from only a handful of public stocks in the 1990s to the massive market it is today, the same trajectory is expected for the commercial space industry. In the same way that every company today is a tech company, every company of tomorrow will be a space company. Longevity's promise. The vision. What our venture fund focuses on is not if we can extend lifespans, but what happens when we do expand lifespans, what needs to be built to accommodate an aging population. What are the implications for our infrastructure if 50% of Americans live to be 100? Stanford University's Center on Longevity predicts a century-long life expectancy will be the norm for all newborns by 2050. What happens to the healthcare systems, financial services industry, real estate, consumer services, and media on a global scale? The opportunities. Historically, aging has been a local and human services business. Since the COVID-19 pandemic, digital health fueled by telemedicine and AI is having a significant impact on the scalability of our expensive healthcare system to better care for a growing older adult population. But technology alone can't solve the care gap of an estimated 12.9 million healthcare worker shortage projected globally by 2030. We need alternative sources of care like family caregivers. In the US, there are at least 53 million unpaid family caregivers, and there is negligible private economy or support systems for them. Those systems are just emerging, and it's an area we're investing in. 3 of our portfolio companies focus on this: Adali, Carewell, and Rubywell. In financial services, we're looking at new products and services to help with financial longevity and reverse the trend that half of Americans are expected to run out of money in retirement. Financial longevity requires workforce longevity and starting retirement savings earlier and more meaningfully. We're invested in a digital-first, affordable 401k business, Penelope, that services small businesses and increases access to critical retirement savings products for all employees. There's also an opportunity in supplemental insurance for retirees. Most Americans mistakenly think home healthcare aids are covered in Medicare. So how do you build long-term care insurance version 2.0? There are about 4 startups here, including HCG Secure. What caused insurance companies such trouble with earlier versions of LTC insurance was that there was no cap on what was covered. These newer products are right-sized to be able to charge lower prices, and so the reward is lower. But the firms provide services such as helping to find geriatric care managers and know what things states may pay for. Built-in support services mean customers are less likely to need as many days as possible of help. There are also startups focused on dementia care management because we only have 2,000 neurologists in the US, and everyone is going to want these drugs. Isaac Health offers a comprehensive dementia diagnostic plus ongoing dementia care management. Tembo Health offers complete healthcare services for patients with dementia. Both businesses are fully virtual, are reimbursed by Medicaid, Medicare, and select commercial insurance, and can support and educate family members impacted by their loved one's disease. Smaller, thematic venture capital funds like ours periodically raise funds. The buy-in can be around $1 million from individuals and family offices. If you have conviction around a certain early-stage company and can provide relevant expertise to it, founders are often happy to include angel investors in earlier fundraising rounds. Investors without that kind of money but with funds they can take risks with and won't need for 10 years can explore angel investor networks or find ETFs, mutual funds, or larger public companies focusing on longevity tech. An AI-fueled future. The vision. We view AI as the most transformative technology we've seen in the last 20-plus years. This year, the market has narrowly focused on the most immediate beneficiaries and enablers of AI, namely the Magnificent Seven. However, we believe the AI opportunity will broaden out beyond this group to companies focused on enabling, enhancing, and effectively leveraging AI to drive business growth. The opportunities. We look across 3 AI buckets: the enablers, the data layer, and applications. The enablers provide the infrastructure necessary to support AI, such as semiconductor companies, semiconductor capital equipment companies, and cloud providers supplying the infrastructure and data servers critical to running AI workloads. Companies we like here include Advanced Micro Devices and Marvel Technology. Companies in the data layer focus on enhancing data management for AI. These are data infrastructure companies that offer a place to store and analyze huge amounts of data, to train large language models, and cybersecurity solution providers. Palo Alto Networks and Snowflake are among companies we like here. In the applications bucket, you find industries that will use AI to improve products and services they offer. Longer term, companies that can leverage AI to increase efficiency, boost labor productivity, and improve their products and services will be big beneficiaries. HubSpot and Adobe are examples of companies that should benefit here. We are just at the start of what could be a mega tech cycle, with the only areas experiencing real tailwinds so far being the enablers and the data and security companies. Over the coming years, we expect to see the emergence of new applications that will drive a productivity acceleration. This market segment is being overlooked by investors. given that many companies and technologies related to AI are in early stages with low adoption and huge total addressable markets. The vision. Sadly, there are many circumstances of violence and conflict around the world throughout history that guide our outlook on the economic consequences that may ensue. These circumstances always provide further proof that an eye toward diversification and a long-term perspective are essential for investors and the best strategies to safeguard wealth. The opportunities. The world has already transitioned from the free flow of capital and globalization orthodoxy following the collapse of the Soviet Union to a new regime of bipolar spheres of influence with democracies and their allies on one side, and the authoritarian regimes of China and Russia and their allies on the other. With this in mind, there are several macro factors that we view as the most consequential implications for markets. When geopolitical tensions escalate, the resulting effects on the stock market can present a mixed picture for investors. As uncertainty heightens, sectors like defense and cybersecurity often inevitably see a surge in demand due to increased security needs. This uptick in demand can attract investors, boosting stock valuations for firms operating within this space. Additionally, the dollar is likely to emerge as a haven for investors seeking stability, which tends to bolster its value. This dynamic can have a multifaceted impact on the global economy. A stronger dollar can skew trade balances by making American exports more expensive and imports cheaper. Additionally, when U.S. companies repatriate earnings from abroad, the conversion into a stronger dollar can result in diminished profits, affecting their bottom line. Lastly, any Middle East conflict can increase the price of oil. However, several factors may hold it in check. Domestically, global oil prices are denominated in U.S. dollars, so a stronger dollar helps hold the price of oil down. Globally, U.S.-imposed sanctions on Russia and China's slowing industrial growth are also factors to consider. Saudi Arabia has also already telegraphed a potential increase in production if oil prices climb toward $100. If you are going to dramatically change your risk profile, try not to do that at volatile times in the market. As a U.S. investor who spends mostly in dollars, I believe generally in underweighting non-U.S. investments in comparison to the global benchmark of the MSCI All-Country World Index. There are plenty of excellent investments to be found in the U.S. with more transparency and regulation to protect investors than in most other countries. Healthy returns. The vision. Historically, investors have seen healthcare as a haven for stability. That can still be said, broadly speaking, but there is much more to be excited about. Long-term demographic trends, wide differences in outlooks for businesses, and constant innovation, such as the developments in weight loss drugs, make healthcare one of the most interesting spaces to be in as an active manager. The opportunities. It is no secret that with age comes more spending on healthcare, but what is often overlooked is just how much the world is aging. Demographics across developed markets continue to shift older, notably in the U.S., which in terms of healthcare spending means consistently higher demand. This is a long-term tailwind for a sector that has always held the reputation for consistent earnings growth. Not all companies will benefit from that tailwind. Today, many of the leading pharmaceutical companies face meaningful patent expirations that we believe the market is underestimating in their investment analysis. Investors must identify these distortions to avoid pitfalls and consistently hunt for the next big innovation. There is no better example than the rapid development in the weight loss medication space, known as GLP-1s. Already, the long-term implications of these looming mega-blockbusters are setting into the market. To identify the magnitude of impact that GLP-1s could have, our research analysts turned to alternative data to complement deep domain expertise. By gauging early sentiment of users on social media, the team identified just how meaningful the results of these weight loss drugs could be for a user. When you then place into context that there are over 100 million people with obesity in the US alone, the potential total addressable market for these life-changing drugs could be in the hundreds of billions of dollars. Healthcare has always been an important aspect of any diversified portfolio, but with current long-term trends and exciting new innovation, our team believes healthcare can be a source of alpha as much a source of safety. Investors can ride the high tide lifting the sector, but should stay prudent finding quality businesses and hunt the developments that can meaningfully impact patients for the better. Thank you so much for watching this video. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income. Don't forget to hit that subscribe button, and comment below and turn on your notifications so you never miss a video from Passive Income Journey 777.